Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Most of the discussions on the Alpha Exchange podcast consist of guests sharing views on market risk and portfolio construction. To be sure, that leads the conversations down the path of monetary policy, positioning, inflation, and growth. There's a great deal of consideration around the price of optionality and the correlation of assets. But what about insights on the nitty-gritty of getting into option trades, being a liquidity provider to the street, and then risk managing those positions? Enter Kris Abdelmessih, who spent more than a decade doing just that. Now the author of the Moontower Substack and the founder of Moontower.ai, Kris looks back at his time on the market-making front, starting with his formative experience in the renowned Susquehanna training program and ultimately trading volatility at Parallax. We talk about how he sought micro-edge by maintaining sell-side relationships, getting into positions as cleanly as possible, and then having a dispassionate process for unwinding trades for which the vol profile was no longer suitable to own. We also gain insights on the perils of trading off-the-run ETFs like those on natural gas and crude oil, with the April 2020 meltdown in the latter an important case study. I hope you enjoy this episode of the Alpha Exchange, my conversation with Kris Abdelmessih. My guest today on the Alpha Exchange is Kris Abdelmessih. He is the founder of the Moontower Substack, also the founder of Moontower.ai, an options analytics platform. Kris, it's great to have you on the podcast today.
Thank you very much. It's a total pleasure to be here, and I'm a fan of the show.
Yeah, and I am very happy to have reconnected with you. I've followed really your insightful contributions, I would say, to the world of Twitter on this complicated subject matter called options valuation. So you do a lot on that front. So we'll have plenty of really fun stuff to talk about. Let's just learn a little bit about your background. You've got some experience on the buy side, on the market making side, and with respect to options. Give us a little bit of a flavor for your background.
I graduated in 2000 and I started at SIG. I was hired into their assistant trainer program. So I started in the business on the floor of the American Stock Exchange. The very first job I had was I was the clerk in SPY shares, not the options. Back when ETFs, they were fairly new at the time. There was a big crowd that made markets in SPY shares on the floor, which sounds crazy today, but that's how it was. So that's where I started. And I came out of college not knowing anything about trading. I mean, I learned how to use Excel on the job as a clerk in that position. And then I run through the rotation. The way at SIG, the way it works, you spend 6 or 9 months or something rotating at different posts on the floor. So I spent some time in the ETFs. I spent some time in options, index options in particular. And then you go to trading class for 3 months. Went through that and came out and was placed into a pit on the Amex as an option market maker in equity options. And then I spent several years doing that. Then I went to the New York Stock Exchange also with SIG. I was a floor broker for a year. I spent about 6 months after that as a specialist on the NYSE. In the blue room, there was an area where they had one specialist post for ETFs. So I was a specialist in some ETFs like FEZ and LQD and a bunch of the XL products. And then I was asked to go to the NYMEX and help start the commodity options business there. So I went with another trader who was more senior than me, and he traded natural gas options, and I started the oil options business for SIG on the NYMEX floor. And then I spent about 3 years with SIG there. I was in the oil options pit for 6 months, and then I spent the remainder of those 3 years in the product options pit. So heating oil and RBOB options, or HU options, which was the original gasoline contract. That was the transition point. I left SIG in 2008, and then I took 6 months off, and then I came back. A firm called Prime backed me. I was free to start my own business for them. I went into natural gas options. I ended up expanding into lots of different commodity options there. I ended up getting memberships on the NYMEX, the COMEX, and the ICE, or formerly the NYBOT. And then in 2012, I went to the buy side. Parallax, which is a large equity vol shop relative value vault fund in San Francisco, asked me to start the commodity options business for them. So I moved from New York to California, where I live today. And I spent 9 years with Parallax, basically expanding that commodity options vision. I mean, towards the tail end of my years on the floor, started to develop a prototype for a cross-sectional options relative value model, and then basically implemented that with proper resources behind me at the hedge fund. Ran that for 9 years, and then I left Parallax in 2021. And since then, I started writing a couple of years before that, and the last few years have really dove into a number of educational projects, and then more recently, a software, building the option analytics software and really leaning into the writing very hard in the last 2 years.
Well, just in your recounting of your career, you mentioned LQD, FEZ, which is Euro stocks, and Nat Gas. And we're going to circle back to this, but it got me thinking about exploring with you just this idea of the distribution of these asset prices. They're all pretty unique. There's some real idiosyncrasies there. And when I think about products like Nat Gas, especially, I want to circle back to Susquehanna, because as you write a lot and your Substack is just a wealth of information and teaching, and it's very clear that you're drawing on the knowledge base that you've acquired over the years. But I just think a root thought process that I feel like gets back to Susquehanna. It's just been such an impactful organization. Obviously, it's a dominant player in market making and liquidity provision, but also in teaching. And it was really early. So you mentioned a couple of the segments of the training course, and I just was hoping you could expand on it a little bit. The types of things you picked up on, maybe not really specifically, but just the way to think about options and relative value. I'd love to learn more about that.
I'll talk about how it was structured. So first of all, their headquarters are in Bala Cynwyd, Pennsylvania. So I spent the summer of 2001 living there for 3 months, so 10 weeks really. So before you go to the training class, you're clerking for a senior trader on the floor at a post. And then after market, you would go back to the office and you would basically go into mock trading classes. So there would be senior traders, or any trader that was walking around might hop in and just get involved. And you would be doing mock trading, meaning that there would be an options board up on a whiteboard, the calls on the left, the puts on the right, very familiar, just an option montage. Maybe you might have 2 months, and the senior traders would act as brokers, and they would create scenarios. The stock is $60 and they say, how's the 65 call? And people would make a market, and then the broker would make a bid, and you might have to remember where the bid was because maybe it comes in mid-market. And then maybe another broker comes in and offers some other option, and you might say, oh, wow, okay, I'm going to sell these calls, I'm going to buy these puts, and I'm going to buy the stock, and I'll basically have legged a risk reversal for this price, which basically looks like a call spread, and I think that I'm getting 10 cents of edge to do that trade. So you're kind of putting together this matrix in real time. You could imagine it's like getting poker training, but with a coach over your shoulder, where every step of the way they're asking, well, why did you do this? Why did you not hit that bid right then? What were you waiting on? What did you think the other market makers were going to do? Every single aspect of the decision-making is deconstructed. You go through that and they can tell, and later on I would teach these classes, and you can tell very quickly who it's clicking for. Basically, who's seeing the matrix here quickly and playing the game well. Basically, how well you played that game determined how fast you would go to class. And then when you would go to class in Bala, the first 4 weeks were very heavy on theory. So it was all classroom in the morning. And I remember their head quant would come in, and over the course of 2 days, he would derive the Black-Scholes assumptions. And the second day, he would derive Black-Scholes. And it was 4 hours a day. So 8 hours total of Black-Scholes. And I'm not a proper math guy. So it's like my eyes glazed over like 15 minutes into this experience. But you would get all the theory, and then you would have homeworks, and you would be making spreadsheets, and you would be building binomial trees, and you would be pricing converts and all this stuff that I've largely forgotten by this point. But you would spend 4 weeks doing that. And then you would play poker in the evenings. Some people play backgammon, but you were expected to play 100 hours of poker over the 10 weeks. And then The grand winner at the end would be the person with the best Sharps ratio at the end of the 10 weeks. After those 4 weeks of theory, then you would have 6 weeks of mock trading. When I say mock trading, this was on a whole other level. So they had a simulated trading floor in the building and the classroom, and you would have your computers, the handheld computers that you would carry around on the floor of the exchange. You would have your micro hedge options model and whatever other tools in Excel or whatever that you wanted on your computer. And you would make markets, and the screens that were overhead were just like they were on the floor, full option montages, a full simulation behind the scenes. But now you were really simulating the floor. You were mock trading for half the day, and then the other half of the day, a different head of a business at SIG would come and talk to the class. And in fact, Jeff Yaz always comes one of those times and addresses the class. So the one word to really tie it all together is immensely immersive. It's so immersive. You are living and breathing options. I say that probably everybody was dreaming in option montages by the time they had gotten through all this. So that was the training, and they make you sign a non-compete. I remember nobody really wants to sign a 3-year non-compete, but in hindsight, I think that education was well worth it. And it was the best thing that happened to me. It served me well for the next 20 years.
As you were describing this immersive experience, I was thinking, boy, to make that investment in people and then have them run off sounds asymmetric against you in terms of what you're putting out and the risks you take.
They made you sign the contract before you went to class.
There you go. In the spirit of optionality.
That's right.
You talked about market making, backing into things like risk reversals and having to understand combos and where stock is and so forth. And that's really just arithmetic. It's not really vol. It's you got to be fast and you got to be a translator very quickly. And so that's probably going to help you get into positions in a favorable way. And once the positions are on, they obviously live and breathe. We know all about options in terms of how their Greek characteristics evolve based on spot, the passage of time, changes in vol, and so forth. My question is just around reflecting on your days, let's say at Parallax, in terms of getting into positions at the right price versus nursing them along and babysitting them properly, being thoughtful around what the market was telling you, giving you chances to alter that position once it's on. Give us a sense of the combination of those, both getting into the position, the importance of that relative to once it's on the books and risk managing it successfully.
For getting into the positions, I think the experience of being a market maker, that was its main value, was that you understood how screens were being framed, why they might be being framed in a certain way. You learn to price options in a relative way. Let's say I'm looking at GLD vol and somebody's coming in and they're offering a 1-month option in GLD, and I might like the vol level. I may have a signal or an opinion that says, I think these vols look relatively cheap versus the way I'm looking at the world. But you still want to maximize on the execution. At the end of the day, this is a game that is pretty much a game of pennies. You were trading tens of thousands, 100,000 options a day. You can imagine if you're making a penny on 100,000 options a day, that's $100,000 a day. It's a $25 million a year business. But if you make a half a penny, you're cutting that in half. It is a game of pennies at the end of the day. So you can screw up any strategy with bad execution. So the market making mentality was very, very key to getting in and out of positions. And it did evolve. Let's take the example when I was at Prime, and then I'll contrast it to Parallax. When I was at Prime, I was much smaller. I was trading a lot of my own money. I had a backer, but I have a bunch of my own capital in escrow. You're trying to make much smaller sums of money per day than you are at the fund. You are trading smaller lots, and your value to the broker is that you are almost in the customer service business. I'm going to be fast. I will respond to your phone call quickly. I will be easy to deal with. I will be very upfront. I will basically try my best to make you look good while I make enough edge that you keep calling me and that this relationship works. When I'm at a fund where I'm trading much larger and I'm trading more names, I have a much more bird's eye view than being just a natural gas market maker, where that's all I look at all day long. If you're a natural gas market maker, you're a broker, you're one of 100 that I have on my IM or using Ice Chat or whatever it was. I have 100 brokers blinking on my IMs all day long, plus the screens. There's so much coming at me, and I need to be able to respond, be able to parse and prioritize very, very quickly so that I can find the best orders and put together a picture of where I can pick up 2 cents. At the fund, I'm not going to be able to be that fast. I can't compete with the person whose entire livelihood depends on being the best phone call for that broker for the 25 lot. So I have to have a different proposition. I would tell the brokers, I understand I'm not going to be the most responsive person all the time, but here's what I can do. The market's five at 510, and you've got a guy that wants to buy 500 straddles. There's 200 straddles offered at 510. That 200 straddles is 4 little market makers that are offering 50 lots each. I can show you 300 more at 515, and you can fill your whole order at 515. I'll do 60% of the order. And that's a value to the broker, because here the broker is concerned with size, not speed. For him to look good, he doesn't want to move the market that much. That's the service I'm offering for that broker. And because I'm willing to offer that service to the broker, I'm willing to take down more size. That's how I get the phone calls there. So you have to understand all the time what your niche is in a marketplace. Are you going to be fast and try to get, like, that broker is not calling me with the 25 lot, unfortunately, but that's okay. The 25 lot, I'm going to need a whole lot of them to move the needle when I'm at the fund. So it's okay. I understand my role in this ecosystem, and that is the execution part, is understanding your service to the marketplace. The position management part, that's the risk management piece. So I buy this vol. I think this vol is cheap, like on a relative value basis. But maybe that asset just stops moving. And what I thought was cheap vol ended up being self-fulfilling. And the entire cloud of asset prices on this cross-sectional view has all moved around. And in fact, this vol is now high. Well, now I'm just working out of it. I'm just selling out of that because my signal says this is now expensive vol. The fact that I lost money, it's irrelevant. I don't even know where my entries were. I don't care. This is now expensive. I'm now selling it. It's irrelevant, the fact that at one point I thought it was cheap.
Some part of that is based on the history of the specific asset. Specifically in derivatives, we have a view that the past matters. We certainly should incorporate the past, sort of behavior of, let's just use the S&P. We have some version of the boundaries of the VIX, at least up until now. That doesn't mean it's not going to change. I always say that, boy, at the end of 2019, no one knew that an 81 VIX was coming 3 months later. No one knew that 2017 was going to see the S&P realize 6.5 for the year. You just didn't know. The environment changes over time, but there is some element of an asset having certain properties. I'd love to just talk a little bit about some of these quirky ETFs. Anytime you get into a commodity, especially something like nat gas, where you have the weather, a big part of it. You weren't trading nat gas options when the Russia-Ukraine war started, and there was all this risk around the cold winter in Europe. And it just created, obviously, an explosive uptail in nat gas. The vol just went bananas. I know you traded the USO in April of 2020. Pick out a couple from your perspective that were just really, really good learning experiences that taught you that the history of data is important, but you got to be careful not to lean into it too much because the world is new and changing every day.
We can go into the USO one. I know you've heard that one before, but there's a predecessor trade to that one that primed my mind for being able to think about the USO one, sort of recognize what's going on very quickly. It comes from a scar. Back in, I think it was 2010. At the time, I'm at Prime. I did have this background in ETFs, not so much in ETF options, but I had it in ETFs. And Prime, they mostly backed futures and futures options traders. You could think of them as basically regulated by the CFTC. They didn't really do any SEC kind of products. But I'm trading natural gas, and UNG is an active product. And I went to them and said, I would like to trade options on UNG. Also, I have a little model here. In general, I think with these commodity ETFs, those are more of tourist markets. Like if you are a serious commodities trader, you are using the futures options. And so the futures options are much deeper, bigger markets. And They are the fair vols come from those markets. The ETFs should be priced off of what is fair in those markets. Like if you put a trade on an ETF, you could go hedge it in the futures options. If the futures options are fair, the ETF has an opportunity to be mispriced. So I said, I want to trade some natural gas. I want to trade UNG options as a complement to my natural gas book. To their credit, they'd never done anything like that before, and they gave me the green light. So I start doing this. There's an opportunity. I'm like, okay, look at the UNG. This was summer 2010. And remember, UNG looked like 3 vols cheap compared to the futures options. So I'm buying some UNG vol and offsetting it in the futures options. And I think I'm getting like this 3 vol ARB. If you remember, this was at a period of time where there was all this talk about, it's like the paper barrel thing. Oh, all the investors, the speculators are pushing up the price of real things that real people need. They're pushing up the price of energy. We're pushing up the price of corn. All of these things that are causing distortions at the pump or in people's lives. There was a bit of a backlash to the financialization of commodities. So UNG announces that they are going to stop. They put a limit, a cap on how many shares they were going to allow to be created in response to this backlash. A very, very smart trading firm that I did not work for anymore, and I don't know for sure exactly who it was, but went out there and created all the shares up to the cap, knowing, of course, they're taking a very informed bet that ETF would go to a premium to its NAV. So here I am, long UNG options and short nat gas futures options. There's a big premium in the NAV. And what happens is UNG stops moving. I'm long options on UNG and it stops moving. The futures options continue to whip around and I'm short straddles on those. So what was happening? As natural gas futures would drop, the premium to NAV would just simply expand because UNG is scarce. The shares are scarce. So the price really wouldn't go down. So the premium would just expand. And then on the days when natural gas futures would rally, again, I'm short options on those, UNG just doesn't move and the premium would just narrow some. So what happened is the premium to NAV was absorbing all the volatility of the futures. So the futures are moving at 60 vol. I bought UNG vol at 57. And now UNG, first of all, is not moving. So my realized P&L, I'm just eroding on the theta. And then the implied vol on UNG just collapses because everyone can see that it's just not moving anymore. So I'm long 57 vol and vol goes to 35. So I lose several months of expectancy on this one trade. Luckily, I only had put the trade on, it was like a 1-month trade. Not a great experience for my backer. To their credit, they let me do this kind of stuff more and more. This is a great example of you're just not sure how strict these relationships can be. There are gotchas in here. So that was one example. That example was the thing that prepared me for the USO example. I'll give the short version of the USO example. Everybody remembers the oil futures in spring of 2020. They had went negative. We woke up one day and USO was trading at a large premium to its NAV. The naive view is that, there's a lot of retail people buying USO because they see that oil futures went negative and they just want to buy the snapback and they're not enabled for futures. So they're going to go in and try to buy the ETF. But we looked at it and said, I actually think that, there should be a premium to the NAV because if you think about USO had fundamentally changed. It was no longer an oil future, but it was an oil future with a zero strike put. Or you could think about it as it was the zero strike call on oil. And you can understand that because imagine you are long USO and you are short oil futures. When oil goes up, trading $10 or $15, they're going to act the same. Oil goes up, you lose on your oil future and you make on your USO and you break even. But what happens when oil drops below zero is you're stopped out on your USO, you're long USO and it cannot go below zero. And then you are just short the futures. So your P&L diagram looks exactly like a put option.
And just the bearer of that risk, because effectively an option has been given away. I think it was called the United States Oil Fund, the ETF provider. There's a free option there that's been provided. Who is short that free option?
They're bearing the risk because they have the futures backing the ETF. That's the problem, which is an important key to where we're going here. By the way, their futures are now trading negative. So there really is a zero strike call that is out of the money. So you can look at the option prices of the various strikes, the zero strike option and the futures options, and you can say, I have an idea. I'm looking at that implied vol, and I can actually model that premium to NAV as extrinsic option premium. It was an option. USO had turned into an option when oil is below zero. So what we did was we computed what we thought the fair premium to NAV was dynamically based on the implied vol in the underlying futures. We were able to form an opinion about what that premium to NAV should be. And of course, as oil futures move away from zero, like if they went back up to $50, the premium to NAV would go to zero. It makes perfect sense. It's exactly like an option. It would be very deep in the money at that point. There would be no extrinsic. The thing that we had noticed was that we thought that USO vol, so the options on USO, were a sale relative to the futures options. There was really three components to that opinion. The first was it had a small weight, and it was just the idea that, as you said, USO, the fund backing it, is bearing the risk. There is a non-zero chance that this product goes to zero, that USO gets wiped out, obliterated off the face of the earth, which would zero out all the extrinsic time premium. And there were 9-month, 1 year, longer than 1 year options listed on this thing. And they were fat because the vols were elevated. All this extrinsic time premium would have went to zero if USO goes to zero. I mean, it's an absorbing barrier. So that's one small reason why we thought should be some discount to these options because of that possibility. The bigger reason, the second reason, which is a bigger reason, is that USO was no longer an oil future, but it's an oil future plus a put. In other words, it's not just a portfolio of oil futures, it's a portfolio that includes a hedge. A hedged portfolio is mechanically less volatile than just the portfolio without the hedge. We knew that when you're near zero in the oil futures, as oil rallies, USO is going to go up, but not one for one, because what's going to happen is that premium to NAV is going to decay and act as a headwind on the rally, and vice versa. The same thing's going to happen when oil is going farther below zero. That portfolio that's called USO, which is actually a put plus the futures, is less volatile than oil futures. So that's another reason why it deserves a discount. The final reason, again, goes back to thinking about the position that the United States Oil Fund is in. And that is, they tip their hand. They're worried about their business. They don't want their ETF to go to zero. So they rolled out the futures off cycle. They just decided, hey, we're going to roll the futures out here into deferred contracts. Deferred contracts in commodity futures are mechanically less volatile than the front month future. The nerds call this the Samuelson effect. An easier way to maybe think about that is that an oil future a year out in time has some mean reversion baked into it. The demand and supply are more elastic a year out. People can decide, hey, we're going to drill more or we're going to ration our use of oil. So the price in the long term is just less volatile than the price in the near term, which really, in this case, we just ran into storage constraints.
So you'll see the same in rates. You'll see the beta of the front month VIX future is going to be higher than the beta of the 4 or 5 month VIX future. So yeah, that was definitely vol dampening in combination with, I think, this idea that the longer dated ones, I remember looking at this, that you could sell this. And this is always, to me, an interesting aspect of especially complicated, unique ETFs that, especially when they have things like commodities or they're on vol, when it's not on an equity asset, you just cancel it. They just decide. And then there's always a real risk, I think, for the long dated option holder in that context of just losing time value.
The intricacies only become important in these edge cases where stuff gets weird, and then these relationships really blow up.
I want to talk a little bit more about this just notion of vol surfaces and distributions, but maybe a little bit more from a technology standpoint. And I think this will lead us into some of your work at Moontower. One of the things I was just talking about on this podcast was the extent to which we are flooded with not just thousands of ETFs with options on them, but even per ETF, you've got so many strikes and so many expirations now. In the S&P, you have an expiration every day, and you've got hundreds of strikes. And it's much more than a mere man can look after. You're going to need the help of a pretty fast machine to do so. And I was kind of riffing on this idea of price discovery. especially with your experience in trading these non-standard ETFs, price discovery in something like SPY, no big deal. You kind of know where it is because everybody knows where it is. But with something that's non-standard and off the run, the price discovery process is a little trickier. And that's for at the money in kind of the expiration sweet spot. But then you've got all these other expiries, all these other strikes. And the construction of the vol surface is very much a mathematical undertaking with heavy help from computers and technology. I just was hoping you could talk a little bit about that. The idea that we start with at the money vol, but then we get this big giant vol surface across strike and time and the thought process behind that. And I guess I'll just finish with, I saw one of your pieces talked about GME. You wanted to do something in GME. I, for one, was just absolutely blown away by the pricing of GME on January 27th of 2021, not because the vol was 880, but because it was 4 vols wide at 880. It's a triumph of machines in being able to price something with that specificity at such a high and inflated vol level. So tell us just a little bit about how a vol surface is created, starting with close to the money options and sort of the way in which someone like yourself thinks about the surface and the distribution.
If you trade things that are opaque, this is a major issue. For things that are basically liquid, it's sort of a non-issue. I mean, these market makers, they're setting curves at incredibly fast speeds. They have very sophisticated models. It feels like a solved problem from if you're looking at the grand scheme of things. Where it's the most interesting is where markets are opaque. And I have a lot of experience with this. The big example was going into the products options pit. So I was trading oil options. And even when I started in oil options, it was a bit of a problem because when I got in there, we were just transitioning into a world that actually had screens. What you had was you had some very primitive software that had a bunch of strikes, and you could basically set a spline. You would have some fixed grid points. You could set them, say, 1 standard deviation up, 2 standard deviations up. And let's say the at the money is $100. I know what the straddle is. Straddles are very liquid. So I can use the straddle to get the at the money vol. And then let's say the 110 call is the 25 delta call. Okay. The 25 delta call just traded for this price. And the straddle's $5. And let's say that the 25 delta call, if you set it to $1, you end up with like a pretty smooth vol curve between at the money and 25 delta. But right now, all of a sudden, that call trades $1.10. And now you have a problem because the question is did the call skew blow out or is the straddle higher? And if you don't have any screens and you go to quote the straddle, you don't know if the straddle's actually higher because the market will be made higher because everybody else saw that the calls trade 110. So they suspect you're coming in here to buy straddles so that you could leg this call spread for a cheap price, 100, 110 call spread. But their bid may not be real. What happens is in these opaque markets, you always have this problem. Did the vol change or did the skew change? Because the things are not trading simultaneously and there's no screen for you to look at and compare, or the screens are wide. They're wide enough that there's enough variation in these relationships where you could be wrong on a $5 wide call spread. You could be off by a dime on what that thing is really worth. So what happens is you really have to be heavily involved in that market, watching every print, paying attention to where the stock was when that thing printed and seeing where adjacent prints are. And then you're forming a picture. My analogy is you are catching fireflies. It's a summer night in New Jersey and you're 12 years old and you're out there and the firefly flashes. And then you're like, where do I think it is now? Because I want to catch it. And I'm not sure if it went to the left, to the right, it went down. And to triangulate where the fireflies are, I need to see like a couple prints in a row to see like what direction it's going in. This problem was very acute when I went to the product options because there, nobody wants to give up any information. The quotes, it's all fog. The quote could be $5 at 510, fair value is 480, and the market's 510 because people think that the order is a buyer. There's no way to really figure these things out until you just get super immersed in that market. And over time, you figure out the patterns, of flow, and you start to understand why are these markets lean this way. I think that people think this sounds like old tradecraft from the floor. This is happening today. It's happening electronically. I was talking to a friend that was talking about how there's these derivative income ETFs. These large ones, they have these large rolls and they're predictable. And he was kind of remarking how amusing it is that these rolls will go up or these trades will go up at mid-market. You might look at that and be like, wow, look how efficient this market is. It's just willing to take down, I don't know what the numbers are. It's willing to take down 10 million Vega mid. I think that table has been set. 20 years ago, you come in the morning and you have an opinion about, I'm going to set my curves this way because I know that this guy bought some puts 3 weeks ago. The market has went down. His puts have doubled in value. He's either going to come close or he's going to roll down because he's still bearish. So if he's going to come roll down, he's going to come sell that put and he's going to buy a put below. So he's going to sell the put spread. So if he's going to sell the put spread, what do I want to do? I want to lower my at the money straddles and I want to raise my put skew and make that put spread really cheap. So he comes in, he offers it mid-market. I buy it mid-market. I buy that put spread for $4 when I think it's worth $4.20. And then over the next couple of days, you walk that market back up to $4.10, $4.30. You are anticipating that flow ahead of time. You know that the guy's not going to come in and want to hit the bid. So you know he's going to be looking for a mid execution. So all of this stuff I still think is happening. It's pretty hard to do these things in SPY. And like maybe if the telegraphed flow is enormous, you could do it. But this has always been part of the options trading game. And I think that tradecraft is just hidden by technology now. And when you say, wow, how is GME 4 vols wide at 800 vol? I would have to wonder, how good is those market makers' information? Their market width is a reflection of their confidence. So if they're making the market tight, maybe they think this thing is a sale. They think the vol should be 800 and they're making it tight and high because they know that the flow is a buyer. The flow is vol insensitive. And if they make it really wide, maybe nobody would trade. So they make it tight and high, knowing that there's very small likelihood they're going to get hit on their bid. And if they do get hit on their bid, they'll just buy a little bit and move. But this way they can hold it up so they can smack the bids that are coming in. This is just me speculating because I'm not on those desks.
This is sort of what happened in the VIX on August 5th. Clearly, this stuff originated outside of the United States. There's a yen carry trade unwind, but it filters through. We know there's a linkage between these classes of risk assets. Could be anything. Could be a yield curve trade. Certainly, VIX has a vulnerability. It got much more dislocated, I think, than most people thought it could. And so my take is the pricing was, okay, we can't really sell any more of this, so we're going to price it really, really high, such that no one really want to buy it. But we don't really want to buy it either at these prices. It's kind of a market that's just reflecting the pricer's desire. But I also wanted you to reflect on this. As we were talking about GME, I was just thinking about the triumph of technology on such a high vol asset. And you've got all these strikes. People are trading furiously with enormous option premiums, obviously because the realized vol is so high. But it really is a triumph of technology to be able to make all these prices available and actionable at a given point in time. And what I would want to really differentiate that against is what you said earlier, which is, let's say in your old days in a seat, getting a call from a sell side firm who's got a client who wants to do something. And you realize you are there obviously to make money for your firm, but there is some version of, hey, I want to keep this call coming in. It's a good call. There's a relationship here. And so you may put something up that's marginal because you want to keep that call coming in. That's the way the sell side voice game has been played for decades. In the world of electronic liquidity, it's faceless, it's nameless. You can be at a price and then just suddenly not be there. Your machine just kind of shuts down, it decides it sees something in the vol regime or the behavior of the underlying asset that's doesn't set up. And so suddenly your price changes quite a bit. It's not really a person making that decision. It's already been made by the parameters that are embedded within the model. And that's very different. That's, I think, quite an interesting change. The advent of technology and the way in which executions are done, especially think about the zero DTE space. That's not someone calling someone up who makes his way to a sell side trader, Goldman Sachs, who makes a price. There's no voice intermediation on 95+% of this stuff. And I think that just creates a different dynamic. I'd be curious what you think about it.
It's 100% true. And it's been increasingly true. I mean, there's no value add for you to be a phone call to trade something in the front month in a futures option. There's just plenty of screen liquidity at this point. You're there because it's still crickets 12 months out. Your role there is to trade these longer duration things and stuff that's just generally harder to price. Something that I do think is kind of interesting, this kind of gets into like the fragility or not of liquidity in the microstructure today. I'm no expert on this, but I think that there is a story out there that is very valid about liquidity is far less than what it used to be. And these quotes, they can just vanish. I don't know to what extent that has to do with consolidation, because the story of the options market of the last 20 years, if you were to just zoom out, when I went to the floor, I don't know how many different colored jackets there were on the floor. There were a lot of firms down there. Lots of mom and pop little trading shops. SIG was a big player. Timber Hill was a big player. You had Spear Leads. I mean, there was plenty of larger players, but there was so many wildcats. Now, the market making world is vastly consolidated. You would know far better than me today just exactly how many firms make up 80% of the market share or something like that. But it's a much, much smaller number than it used to be. And the story of options over the last 20 years has been returns to scale. I say the market making, the prop firms, Jane Street, Citadel, these companies are converging on tech companies. As a matter of fact, they're hiring the same people. It's like they all want to hire the same people that Google wants to hire. They don't want to hire me. They want to hire Math Olympiad kids. The returns to scale have been enormous. I don't know if this is by consolidating, if you've made it more fragile. Remember, like all these firms, they're running pretty similar models. I mean, Jane Street came out of SIG. Citadel Securities, their options desk, there's a lot of SIG influence in at least the most recent iteration of it. There is a lot of similar thinking that is behind all the firms that run these trades. I mean, Parallax is a SIG lineage as well. When somebody's asking me for a quote in some bond option ETF, it's a customer on one side trying to buy 50,000 puts. It's like me, Jane, and name your cast of characters on the other side. We're not trading with each other because we think the same. That consolidation probably has made the market more fragile. The other argument to that would be with payment for order flow and the competition to be in the exchange's good graces. At the end of the day, the exchanges are the point of power and centralization. To be in the exchange's good graces, you probably do have to be a good citizen market maker and stand there and take some trades that keep an orderly market. They have much more visibility into the executions and your behavior. And so they can kind of hold your feet to the fire on that. And I'm not sure what the competing effects are. My guess is that it's more fragile, but there's no way for me to really know. Going back to the August 5th thing, I went into the community chat on Moontower, and the first thing I chatted that morning was I looked up EWJ and I looked up USO, and I saw that DEES USO vol was 32.38, which is obnoxiously wide for USO. And EWJ was 20 vols wide. I mean, it was 20.40 on the vol. I had never seen anything like that in my life. For EWJ to be 20 vols wide is unheard of. And I know I listened to your episode with Vinir Bansali, and he talked about this too, about he had never seen the liquidity vacuum that happened in the yen in his career. And he's been around a lot longer than I have. I think that there's a lot of credence to the market becoming more fragile because there's less players.
Well, let's finish off with a couple of your current pursuits. So talk to us a little bit about Moontower, the Substack, and what you're up to there. I've certainly spent some time reading through it, and you've got a lot on your mind. And obviously, it's very option centric, but you tend to relate some of your options expertise or your philosophy to life matters as well. So I think you have some fun with it. And obviously you have a very strong subscriber base. And then just tell us a little bit about Moontower.ai as well.
For the Substack, I started it 5 years ago, but today I publish 3 times a week. I publish the OG letter is on Sunday, and then I publish on Wednesday, and then I tend to publish a much more options centric. The Thursday one is paywalled. I mean, that's the one where I'm really diving into stuff more and oftentimes looking at data and showing stuff. But the letter, it started as curation. Here's things that I read that I thought was interesting, and then maybe my like take or blurb. And that's kind of how it started. It was just an experiment. As I would comment on things, especially things that were financial, I would analogize to options trading. And that seemed to resonate. It was weird. I kind of realized at that point, I might know some stuff that is not common knowledge. And I started writing about that. And that's really how I got the following. I do write a lot of stuff that's not options related. I write a lot about family matters and raising kids and playing games and teaching kids and some culture stuff. And a lot of readers give me the feedback of I came for the finance and stayed for the life. That's been a very consensus thing. The letter is very personal as well as being technical sometimes. When I left Parallax, I did not even look at markets on any consistent basis for probably at least a year and a half. But then I started getting a hankering to be able to see the world through the lens that I had become accustomed to, the way I had looked at things for 15 years. Through some serendipity, I met a guy named Emmy Gal, who he's the founder of this company called Ezra, and he's a software developer by background. I was coaching him on options stuff. He was trading crypto options for his PA. And as I was coaching him, I realized that the way I was teaching him was this progression. That was the very progression of how I thought through trade ideas. Because he was a software developer, he was already buying all this data and everything. I would teach him something, and 2 days later, he would turn around like a prototype with a UI to be like, okay, here's this idea. Here's how it looks. This is populated with data. And I'd just be blown away. Like, he just turned us around so quick. It's not even his job. We started doing this. And then I was like, let's build this out because I want to be able to have dashboards like I used to have. One day, he went and bought the Moontower.ai URL and said, we should make this available to subscribers since we're doing it for ourselves. I want this thing anyway, so we can't really fail if we want it for ourselves. We finally launched it in March. And the way I would describe this analytics platform is, if we back up, we understand that most of the world does not think about options as their own source of opportunity. They have opinions about assets, stocks and bonds and currencies and what have you. What I like to say is they wake up with an opinion or an axe on whatever stock. In other words, they think the securities are mispriced and they just assume the options are fair, and they go to the options market and they sometimes express their bets through options. Vol traders are the exact opposite. Vol traders, luckily, us brain damaged people, we make up a very, very small percent of the overall investing landscape. And we look at options as a source of mispricing, and then we assume the underlying is fair. So our position is exactly the opposite of the typical investor's position. What the software does, it's a step-by-step progression for how we think about options. What we're really trying to do is say, you had this idea that you wanted to trade options to express your bet. Let's give you the vol trader lens.
And I've always had that mantra, take what the vol surface gives you. And you don't even have to think that something is theoretically rich or cheap. And we can argue all day long if that's really something you can calculate. I think experts can professionally disagree on whether something is rich or cheap, but the surface does move around. And there are times when it really does facilitate something that you'd like to do. I always go back to certain energy names, for example, when crude has had a big rally, let's say it's post Russia, Ukraine, and you get a big ramp in crude in March of 2022. And obviously the call skew gets really high. So that translates into the equities, and you can do things like 1x2 call spreads and get paid a handsome amount for selling off that upper strike risk. So sometimes the surface does come your way. It's interesting. Well, Kris, this has been a fantastic conversation. Give us a lot to think about. It's also really good just to say that you found a professional passion and being able to take that and combine it with your own voice on life and getting a lot of subscribers and folks that are interested in hearing what you have to say. So congrats on that, and best of luck on the very specific business pursuit on Moontower.ai as well.
I appreciate it, Dean. I appreciate you having me on as well. Like I said, I'm a fan, and I'm a fan of your firm. You get bombarded when you're on the buy side of different research pieces, but the ones that your team sent were always a must read for me because they tended to be very actionable, insightful, and brief. They were just super punchy and great. And when you're getting swamped with stuff, I think you guys cut right to the heart of things oftentimes. So you guys are doing great work, and I appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.